Here we are.
Hello,
Hi,
everyone.
Hello, everyone.
hi everyone. Hi guys. How you guys doing?
Fine, thank
Good,
you.
good. And yourself?
I'm good. I'm good. So basically, we have another episode of our podcast, Making the Right Move, and this is the second part to the series that we're running currently, which is from renting to home ownership. And today we're talking about applying for a mortgage. And we have obviously none other than
Resident mortgage expert.
exactly Dr. Golden, Kola Olasimbo in the house. He's a mortgage agent, as we know, and he's going to be walking us through, you know, the entire journey from when you start trying to apply for a mortgage to to closing on a mortgage. And yeah, so welcome to the show. We're
Thank
happy to
you.
have you guys here. So, Kola, over to you.
Hey, hello, everyone. Like Kaide had introduced, it's a follow-up episode on um, moving from rent to owning a property,
Correct.
um, especially, well, mostly first-time home buyers. Um, we Today we'll be talking about mortgages. Uh, to start with, for everyone that wants to step out there in terms of going in to purchase a property, it is very, very important to have an initial assessment done because, hey, what is the point? What is the aim if you cannot close, if you cannot finish it? What's the point of going out there, employing a realtor? You grab Kai, they grab Tanuke, they step out there to purchase a house for you, and you cannot grab the keys to close on that house at the end of the day.
Yeah.
In other words, you're not able to get a mortgage. So it's usually better to have a pre-assessment of what you qualify for, what you can afford to buy before stepping out there to actually go start viewing properties or making offers or signing offers. So
Correct.
in other words, we have a lot of advantages when you work with mortgage agents because, hey, for instance, now I work with a brokerage where we have numerous lenders. I'm not tied to only one bank, as opposed to when you go into, there's nothing wrong with doing a pre-assessment with your bank, but a
Yeah,
lot of times you have limited options when you
that's
walk
right.
straight into the bank, right? We also still deal with banks on your behalf, right?
Hmm.
Look at it this way: you want to go on a trip, um, you could drive yourself, but hey, wouldn't it be nice if you had a chauffeur, like somebody that's gonna take you there while you sit back and relax? So
And
that's what
relax and
agents do.
enjoy the ride.
Exactly. You employ us, we actually work for you. I'm
Mm,
not tied to any bank. I'm not working for a bank. So if I'm going in to negotiate a deal, I'm negotiating a deal for my clients. I'm not,
that's right.
well, I should have some remuneration from the bank, but that's not the actual aim at this in that scenario. It's usually getting the clients the best deal based on their different scenarios. Now, some banks have different options that they offer as well, but there's different categories of clients. You have people that are full-time employees, in which case they have company XYZ that has employed them.
Right.
They have their fixed hours. They are on payroll. They get their CPP, EI. They pay their taxes. So,
And they
and
have
then
some kind of fixed income, right?
fixed income, full-time salaried income. It could be salaried, it could be hourly. They have income that is fixed, right? And at the end of the year, you usually have a T4 from the government because the employer is deducting their taxes from source. So one of the ways to prove that when you want to take on a mortgage is to actually have uh, proof of income, in which case you're showing your job letters, your pay stubs, your T4s, notice of assessment, and things like
Mm,
that. Now you also have the people that are actually employed, but they're contract staff, and that is becoming a lot more
come on these days. Yeah.
These days, yes, a lot of, especially people in the IT space, project
Yep.
managers and things like that, a lot of them are contract staff, in which case the criteria for their own assessment of mortgages is quite different, right? It may pose a little bit more of a challenge, but in which that's one of the other major advantages of going with the mortgage broker, because now we have access to the lenders that have the different levels of tolerance for those different and carry different products for those different types of
Clients or
uh,
customers.
yeah, jobs and things like that. So
Mhm.
we also have the business for self owners, like
Right.
we all sitting here now, business.
Self-employed. Yeah.
Well, in as much as we're attached to brokerages, we are self-employed, right?
That's right.
So you own your own, or you own your own business. Even project managers sometimes, and some of those in the IT space are actually self-employed.
Self-employed. That's true.
In which
That's
case,
true.
they're employed not directly as themselves, but maybe through their
Their
sole
business
proprietorship
or their
or
corporation.
corporation, right? So now there's different products out there as well amongst various lenders where you are opportune to be able to kind of pick and choose. I like to use the term putting the pieces of the puzzle together. So
Right.
if you're sitting down and we can do an assessment and I can tell you, hey, well, TD has that product, or Scotiabank has a better product, or First National is your best bet. There's so many options out there, as opposed to you just walking into TD, for instance, and TD doesn't have that particular product that suits you. And hey, you think, oh, that's the end of the road. They said I cannot get a mortgage, or I have to come back in another 5 years, or whatever the case may be. Whereas there's other options where you could jump on, right on, and be able to get a mortgage. So it's always good to have that assessment done, and that would actually help tell you based on your income debt ratio, right? That would help guide the real estate agent to know, okay, like Mr. ABC and Mr. and Mrs. A can afford to purchase a property within a certain price range. Okay, maybe you're out there going for an $800,000 property. That's what you can qualify for. That's what you can afford. Maybe you're out there going in for $1 million property. I mean, it's always nice to assess so that you're aiming to be able to finish up what you started happily,
And it
right?
gives you a where you fall.
Exactly. So the income debt ratio, like I've said some things about income. The other part of it that we really pay a lot of attention to is your debt. What kind of debt are you carrying? Do you have car
Right.
loan? Do you have credit card debt? Like, what do you have sitting on your credit bureau? Because your credit is another major factor as to what would help you qualify for a mortgage, right? So that assessment is critical. We do have some types of ratios that we look into when we're doing an assessment. We have what we call the gross debt service ratio. That they generally called the service ratios. So you have your total debt service ratios and your gross debt service ratios, in which case all the lenders have particular percentages where your qualification um, kinds of qualifies you for a mortgage or not, right? So in the process of having your ratios aligned with what a particular lender would accept for mortgages, that's where your it's more like, okay, so the idea is, if you're earning X amount of dollars, how much from this are you allowed towards your
mortgage repayment?
over your head, right?
Right.
Factoring in that, okay, you already have X amount of dollars in debt that you have to service as well. We're talking about you making payments on a credit card that you have used some money on, or you're committed to car loan payments monthly, or you have a personal loan that you've taken, or line of credit, things like that, right? It could be a furniture store loan, it could be anything. So that helps us factor in, okay, you're already committed to somebody that has $5,000 coming in per month. You're already committed to paying $2,500 to service all your debt. You're left with 2,500. There's only a
Right.
percentage of what you earn that you are allowed to actually expense, and they also kind of have it in that you should be able to save, right? So it boils down to what are you able to expense, and those ratios actually help guide us. So we take
Okay.
information, and that's where we try and help you sift. Sometimes we have to recommend, okay, you have to pay down this debt to be able to achieve, to be able to get
Just
that. Yeah,
just to adjust things a little. So yeah.
those things that will suit you. In which case, that's kind of where uh, we can advise
Hmm.
and sort of guide you towards getting the best deal out there.
Okay. So you made a comment earlier, and you talked about car loans.
Yes.
And that kind of stood out for me. What's the general impact of something like a car loan on one's ability to access or give a mortgage?
That's actually a very, very valid point that you just raised there. A lot of people are unaware of the impact of taking on car financing before buying a house. I'm
Right.
going to paint a very simple scenario. It actually is one of the um, biggest dents you can have on your finances when you're going to apply for a mortgage. So,
Okay.
your car loan payment, right, is seen as a fraction of what your monthly uh, servicing can be in terms of what you're getting in from your income. So let's assume somebody has an income of say $100,000,
Right.
and from that amount, if it's someone that is absolutely debt free, zero debt, nothing, it does have credit cards, but he's not carrying any debt, he's not servicing any debt when you hit the credit bureau. That person may or may not qualify for anywhere between 400 to $450,000. I'm just throwing out numbers here. Don't hold me to that. So
Okay.
in that case, if the person assumes the person qualifies for $400,000 now, if that person now takes on a car loan where he's making payment of say $500 a month on a vehicle
Okay.
he purchased for $40,000, right? 50,000, 60,000. It just means just don't hold me to these numbers, but just to make things clear, now you have a payment of you committed to a payment of $500,000.
Mm-hmm.
That $500 payment can grossly impact what you qualify for in a mortgage. It could cut you down from a $400,000 approval to a $300,000 approval. Now,
Whoa.
do the math. Like
Mm-hmm.
for every $500 payment, you're
You know,
losing the equivalent of $100,000 in your borrowing capacity for a
you know,
mortgage, roughly.
you know what? You know what? I'm going to say. I want you to say that again. Just hold on a second. I want you to say that again.
Yeah.
The talk about that. The impact of you having to pay, for example, $500 a month on your car loan, and how it can impact on your borrowing, the borrowing amount, how much you can, how much you can borrow.
For every $500 payment you're making on a car, be it a 20, 30, $40,000 vehicle, for instance, you're losing out about $100,000 in your borrowing capacity for a mortgage. It's
Sorry,
huge. It's huge. That's one
that's
of the
big.
because it's a fixed loan. It's a fixed amount. Now you've tied that to a depreciating asset, right? I'm also in the dealership space. I'm a car guy. So I'm not trying to, but here we're talking about your advantages of getting a mortgage. I'm not
Right.
trying to tell you that you shouldn't finance a car, but don't put the cart before the horse.
Correct. Do it at the right time.
Do it at the right time. If
Mm.
you have plans of owning a property, buying a house sooner than later, when you're going in to buy a car, then my advice would be to buy what you can afford at the time that you're paying cash for. Or you should have resources to have paid off that car loan prior to jumping in the mortgage wagon, prior to applying for a mortgage, so that you can maximize your ability to borrow, maximize the capacity, maximize your borrowing amount.
For the right thing, for the
Wait.
right reasons.
Exactly. Or just wait if you
Wait,
can. If
buy
it's
your
not
house
that important,
first.
like, hey, going in with your car,
True.
you're buying a depreciating asset, whereas your home is your home can buy you multiple cars, multiple things
Exactly.
down the line.
Exactly.
So just wait. Like Tinuke suggested now, waiting is not a bad idea. Or buy what you can afford. Why
Yeah.
finance that $40,000 vehicle when you have $5,000 down? And look for something that gets you from point A to B for $5,000. Buy that today, and you can go back and you're actually a better candidate to finance a vehicle when you own a house.
Wow.
And it's not the other way around. It's usually
Please say that one more time.
you're a better candidate to finance a car when you own a house. But when
Right.
you own a car, you're a worse candidate for a mortgage at that point in time in terms of your borrowing capacity. But hey, that formula may not apply to all. And I'll
Correct.
tell you why. There's people out there that their income is well above what that car loan impact is going to make on their borrowing capacity. Somebody is earning
That's fair enough.
$100,000 and he's okay buying a property for 800 grand. He has 10-20% down. We'll get into the down payment soon. He has 10-20% down. And hey, even after you factor in his car payments, yeah, he can still borrow what he needs to borrow.
Yeah.
Go for it. If you're that type of person that you need to have a vehicle finance, go for it because you have the capacity already,
Correct.
right? So it's not in all cases, but when you're in that situation where you need all you can to get your foot into that door of getting a mortgage, of giving a mortgage, then please hold off that car payment.
Makes sense. Makes sense. Makes sense. You know, that makes sense.
Um. So I have a question in regards to first-time home buyers who are probably coming in as single or uh or a couple
Yeah.
coming in thinking maybe the market is so volatile now they can't afford it. One person they believe one person should probably purchase the property and reserve the other person for later, or that two people can't come together to purchase, be
Yeah.
it friends or partnerships or whatever case may be. Can you speak to coming in as a joint investment?
So giving a mortgage to a bank can be 1, 2, 10, 20, 50 people on even one property. Like
Hmm.
there's no restrictions. Um, we look at it as either a household income. The lenders see it as household income when you're doing an application for a mortgage. And just to be clear, I deliberately said the word giving a mortgage. A lot of people think when you go and apply for a mortgage in the bank is the one giving you a mortgage. No, it's the other way around. You, the borrower, are actually the person giving a mortgage to the bank
To the
on
bank.
the property. So when you're giving a mortgage to the bank is granting you, they're lending you funds. Now, it could be you could use a household income where you have people that are earning and they're above the legal age
Age.
can have them on a mortgage. So if husband and wife need to pool resources together in terms of maybe husband alone qualifies for 400,000, wife on her own will qualify for 400,000. When they come together, now they could borrow more.
Okay.
They could give a bigger amount in the mortgage to the bank, to the lender. So combined income most of the time will stand the ability for you to be able to borrow more. I said most of the time deliberately because there's some instances where actually combining people is a negative on the mortgage, right?
Right.
If one person is carrying so much debt and that capacity in their income is already in the red. It's in the negative. Then
Negative. Yeah. Yeah.
right? Because that person is going to end up bringing down even the other person that is good. You may be better off with one person, but
One
hey,
person.
dual income will speak better in most cases. One, two, you could also co-own you could co-own a property. In which case, okay, we have 2, 3, 4 first-time home buyers, friends, family, that are renting.
Come together.
They may be renting together, they may be renting separately, but hey, let's get your foot in the door. If you cannot buy alone, if you have somebody that you're comfortable with, right, you could legally purchase a property and own the property together. In which case, the lawyers help as well in helping you fine-tune your percentage ownership, where you have proper agreements drawn up amongst yourself, and
Exactly.
that can be clearly outlined in your mortgage and title ownership of the property as well. In which case, okay,
Nice.
so you're going in on the mortgage, this is 50-50 ownership, this is 70-30 ownership, this is this and that. You could have that
So,
property outlined.
so Kola, what you're saying is you don't have to go it alone.
You don't have
You
to go
don't
alone.
have to.
No,
Exactly.
absolutely not. You don't have to.
Excellent.
So you can end up with 2 people, 3 people, 4 people. Sometimes you have father, mother, grandpa, grandma, daughter, son, cousin coming together on one mortgage. It happens all the time. The most common
And,
usually is household income.
and it's very important that you raise that point, because I mean, as realtors, for us, communicating that to our potential clients is very, very powerful. Because what that option does essentially is it doesn't restrict that individual to saying, oh, you know what, because I can't afford to buy this home just yet, I will stay away from the market, or I'll just wait until I save enough money, or until I have the borrowing capacity. Whereas if you were to enter into some kind of co-ownership arrangement with someone, it gives you a chance to get your foot in the door. You
Absolutely.
get yourself on the property ladder. You begin to grow wealth by a portion of ownership in that particular property. And
Absolutely.
down the line, you guys can decide that, you know what, okay, we've grown, we've been able to gain some equity on this property from X to X plus Y, and we now want to go our separate ways, and you can sell it. The other party can sell to the other person, or you can sell it in the open market, and you
Yep.
guys walk away with a ton of money that you can go and do something else with.
You can actually go buy individually at that point in time.
Exactly.
Yeah.
Exactly.
If you couldn't carry it alone at some point, you may get to that point where you've banked enough equity to be able to carry a mortgage on your own.
On your own. Right. I think.
Yeah, sorry, go ahead.
No, I was going to say it's really powerful. It's really powerful, and a lot of people, and it's a mindset thing as well. Some people are fixed on that whole mindset of, you know what, I have to buy this property on my own, or I'm trying to do it, and they're working hard at it, which is a good thing, right? But there are other ways of getting into the market and allowing that growth to happen, that then gives you a chance, gives you a better foundation to be able to buy on your own,
As leverage, yeah. So you don't have to buy where you're going to live.
Exactly.
You can be a landlord and still be renting.
Exactly.
It could be, because hey, right now you live downtown Toronto or you live in Hamilton, you're renting in Hamilton, work is close by, everything is comfortable, convenient.
Yep.
But you can really afford to buy in Kitchener.
Yeah,
Hey,
buy in London. Yeah.
buy that London property today, put it out for rent, and continue renting where you are until you can afford that Kitchener or that London property or that Oshawa property. The Brooklyn property may be, most likely would yield the equity for you to be able to afford that Oakville, Hamilton that you want to stay in, downtown Toronto. So you don't have to buy where you need to live.
Exactly.
Yeah.
Yes.
Yet. You're right. Tinu, you're right. You're absolutely right. Yet. But that time will come, if you make the right initial moves. And that's why we're here. to help people make the right moves. Not to sound corny or anything, but it's just the reality. So maybe you can talk to us a little bit about the down payment structure and how what role that plays in all of this, in terms of like the puzzle as you describe it, what role the down payment plays and how, because most people out there say, oh man, there's 5%, like they just do 5% mortgage, and they don't really understand some of the things that go on behind the scenes as far as down payment is concerned.
So in terms of the down payment, um, there's a lot of misunderstanding out there. So I want to make this really clear. There's guidelines that the guidelines and criteria that is kind of cast in stone for down payment structure in Ontario. This is a tiered up, TIER. Down payment structure is actually tiered up in Ontario. And what happens is you go from the first tier is from $1 to $500,000, in which case you're allowed to put a minimum of 5% down, right? That's your first tier. So from $1 property purchase price to $500,000, $500,000, your minimum required down payment is 5%. Now let's just to elaborate on that a little bit before I move on to the next tier. Or you know what, let me break down the tiers and then we'll come back to them individually. So
Okay.
the second tier is from $500,001 to $999,999. That's $1 less than $1 million.
Right.
Your down payment structure is 5% of the first 500,000 and 10% of the balance between $500,001 to $999,999. So the third tier is once you hit $1 million in the purchase price, your minimum required down payment is 20%. That eliminates you from the first and second tiering up of down payment structure. Your minimum required down payment becomes 20%. Once you
hit 1 million. Gotcha.
So now let's go back to the first tier and I'll give an example. I usually like to say, going in to apply for a mortgage, you have to be able to carry that property you want to purchase with two hands. Your first hand is what we had talked about earlier, your income, your income debt ratio, in which case a certain amount you earn and a certain amount you're servicing in debt puts you at a particular level of amounts that you can borrow. I like to use the word your borrowing capacity for a mortgage. Right. Now, the second hand is this your down payment structure. Both have to go hand in hand. We don't have any mortgages in Ontario anymore where you're earning $1 million and you want to go buy a property and you want to do zero down. That doesn't happen anymore. That's gone. Okay. The days where they had that structure, that does not exist anymore. Right now, regardless of what you qualify for, your minimum required down payment, even if your income qualifies you for the entire mortgage amount you need, you're still required to put a minimum down payment in there. So if you're buying from $1 to 500,000, that means you're buying at 500,000 or below, minimum is 5%, which is $25,000. Or 500,000. So assuming could be less, correct? Assuming you're buying a property for, let's use 500,000. Your minimum required down payment is 25,000. Now that means you're looking to borrow $475,000 from the bank. Now they go back to your other hand. Does that hand, your income debt hand, does that qualify you to get a mortgage of 475? If you only qualify, whether single-handedly or as a household income or as a co-partnership, co-ownership, If you only qualify for 400,000, then you're not a candidate for the minimum required down payment. So if you only qualify for 400,000 and you're looking to buy 500,000, your down payment is not 25. Your down payment has to be $100,000.
Right.
Because
So that's why I think that's why that minimum.
That's why I keep stressing the word minimum.
Minimum. Right.
Minimum does not mean that's what you qualify for. It still boils down to both hands.
Correct.
Right? So if you're borrowing, if you can only borrow 400,000 and you're looking to buy a property of 500, then you must have 100,000 in your pocket as down payment.
Right.
If you're looking to buy a property of 450 and you only qualify for 400, you must have 50 grand in your pocket. But if you're in a situation where you're trying to buy a property for, say, 400, let's use 500,000, and your income qualifies you to borrow as high as 550, 600,000 in mortgage. Now, we won't use the word that you're overqualified because they won't give you a zero down mortgage, but you can put in that minimum token amount of 5%, which is 25,000, and the lender will fund you 475,000. Now, let's go to the next tier. If you are looking to purchase, say, 750,000, for instance, your minimum required down payment is 5% of the first 500,000,
right?
10% of the 250,000 balance. So out of that 750, you're only required to put in 5% of 500,000, $25,000. 10% of 250 is another $25,000. Your minimum required down payment at that level is $50,000.
$50,000.
But then we go back again. Your other hand, does your income qualify you to borrow 700,000 to balance that property purchase? If it is a yes, you're good to go. If it's a no, if you qualify for lower, then your down payment increases.
Got you.
Right? And that goes up till you get to $999,999. Just $1 of $1 million. When you cross that bridge, you buy a property for $1 million and $5 on $1, you have to put a minimum down payment of 20% in. Minimum. In which case, that also brings us now to whether when you hear of an insured mortgage, an insurable mortgage, and an uninsured mortgage, it is these different tiers that actually qualify those terms that you keep hearing out there. So any mortgage that is below $1 million,
right?
Property purchase value of below $1 million is qualified for insurance. The mortgage default insurance.
Because so when you say mortgage default, who does that protect? Is it the bank or is it the individual?
Lender.
It's protecting the lender in case the borrower defaults, right?
Correct. So mortgage default insurance is set in place not for the borrower. The borrower purchases the insurance. The bank will purchase, the lender will purchase the insurance on your behalf, but it's actually protecting the lender. When you, the borrower, defaults. Right. And the lenders have to take on that insurance when they're taking on a mortgage that the borrower is putting down less than 20%. Across board.
Is this like a law or some?
It is a law.
Okay.
It's a law. It's a regulated law federally. That any mortgage so when we use the term loan to value and down payments, they kind of go hand in hand. So at the end of the day, loan to value and down payments make up 100% of your purchase price.
Right.
If you're purchasing $500,000 and you're putting in 5%, the down payment is 5%, your loan to value is 95%. If you're putting in a down payment of 10%, your loan to value is 90%. Loan to value, down payment add up to be 100%. of what you're buying. So
Gotcha.
if you take on an insured mortgage, that means that mortgage is less than $1 million. That person is putting down less than 20%. That mortgage has to, by law, be passed through one of the mortgage default insurance companies that are out there. Then your qualifying criteria has to pass through 2 stages. The first stage is your lender stage itself, in which case it could be a bank, it could be another lender that is not a
Lender.
commercial bank, right? So your mortgage default insurance. So after you've passed through that branch level, now that application gets scaled up to the insurer, right? In which
Okay.
case, in CMHC, Gen Water. So it goes to the insurer. The insurer looks at your documents as well, and then you get that final approval through the insurer. Okay, this person we can cover this. This person meets the criteria for this mortgage. So it becomes insured. Now that insurance amount, whatever the cost is a premium that is added on top of the amount that you're borrowing from the.
Okay.
If you're already giving the bank a mortgage of say $400,000 and your insurance is going to be say $20,000 for instance, your mortgage starts at 420,000. You, the borrower, are the one that is going to pay for the insurance, right? It's added on top of your mortgage. Having said that, some of those insured mortgages become insurable. They move away from being insured to insurable because, okay, any mortgage below $1 million should be insured. But you can opt out of that insurance if you decide to put a minimum of 20% down payment into that mortgage.
Okay.
In which case, you're still buying below $1 million. You're buying 800, you're buying 700, but you have capacity to put on 20% down. At that point in time, you have an option of staying away from that insurance.
From insurance, even though you're buying a property that's worth less than $1 million.
Correct.
So the moment you hit, so which goes back to the point you made about the loan to value.
Correct.
So the moment you hit at least
80%.
20% of the value in terms of down payment,
Correct.
you can avoid having to pay the insurance premium.
So when the lender is financing you 80% loan to value or less,
Okay.
you can avoid insurance premium. In which case, we shift that mortgage from being an insured mortgage to being an insurable mortgage. Because hey, it's insurable. You have an option to insure it, but you're choosing not to.
Not to. Makes sense. Makes
Right?
sense.
That's an insurable mortgage. Now, the uninsured mortgage is the third category, and that's where you have the mortgages that are above $1 million. They're uninsurable mortgages because it's a must for you to put down 20%.
20%. So even if you wanted to have it insured, it's not particularly
going to go through that channel before insurance because you are considered a lower risk mortgage.
Got you.
Right. So that's how we kind of categorize those terms. So the down payment structure is a lot of people think, oh, I'm buying 800,000. I just want to put 5% down. No. 5% of your first 500,000, 10% of the difference, 800,000, that's a difference of 300,000. So that is 30,000 plus 25,000. 55,000. When you calculate that, it's a little more than 5%. It may be around 7 point something percent. It's not 5%.
Yep.
Right? 5% portion is embedded in your total down payment structure.
Got you. Okay. I think we still have a couple more questions. I think Tino was going to ask you a question.
You can never, even if your credit is good and you have a good standing with your bank or whatever the case may be, if you're purchasing at 5%, at anything above 500,000, you can never be in a situation where you're paying 5%. You'd have to pay the additional 10% of whatever is over and above 501.
Correct. Regardless.
Okay.
So even if you qualify, like to elaborate on that, if you qualify for, you have a borrowing capacity of $700,000 based on your income, you can borrow 700,000, and I'm choosing to buy a property for 550.
Right.
You don't qualify for 5% only. You do 5% of the first 500,000, and you still have to put a 10% of the 50,000 difference on it.
Makes sense. Makes sense. Makes sense. So another, what Tina wanted to, were you going to say something?
No, go ahead.
No. Okay. So, so I was going to ask, like, another term or some other terms out there that people hear from time to time is, am I getting a fixed rate mortgage? Am I getting a variable rate mortgage? What's the difference between both, and when potentially would you recommend one over the other?
So that's your options in terms of your mortgage terms.
Right.
Now, when you're giving a mortgage to a lender, you have the option of basically two options. Let's put it that way. You have the variable rate mortgages, and there's subclasses of the variable rate mortgages, and you have the fixed rate mortgages that also have subclasses, right? But those are the two broad divisions of the mortgage terms that are available in our market today.
Okay.
Usually, if you're signing up for a variable rate mortgage, right? Sorry, let me take a step back. When you've identified the term, there's also what we call your amortization schedule.
Okay.
Amortization for the mortgage. So there's two things that are embedded in any mortgage loan that you putting in an application for with the bank, considering the previous factors that we had mentioned, what you
Okay.
qualify for, whether you're going with an insurable and an uninsured mortgage. Your amortization schedule is how, because hey, the mortgage loan is one of the biggest loans anybody's going to have in a lifetime. How many
Correct.
things are you purchasing that you're going to be carrying debt of hundreds of thousands of dollars in a lifetime, right? Taking on a car loan, yeah, you owe 40, 50,000, 60, 80, $100,000. But most of the time when you're buying a house, your mortgage is the biggest debt you're going to carry. So having said that, the finance industry has put out options of actually being able to spread out your repayment schedule in a way that it's affordable, right? So your interest payment is not a direct, open, calculated interest. When you say, "Oh, I'm taking on a mortgage of 5%," it's not 5% of your 500,000 mortgage that you're paying for that year. No, it's amortized, right? It's spread over 25 years, 30 years, 35 years, usually starting at 25 years. Most lenders would offer you a 25-year amortization schedule. But in that amortization schedule, you have what we call the term. And that's what you start hearing, oh, I have a 2-year fixed, I have a 3-year. So your term usually could go anywhere from 1 year, 2 years, 3, 4, 5 years, right? Usually not more than that. We have a very few lenders that will let you stretch your term to 6, 7 years. Very rare. Like I've never signed up a mortgage for a 6-year term. Very rare.
Right.
Now let's come down to variable and fixed. We've talked about amortization. Now we're back to the term. So that term is a part of your amortization. If you have a 25-year amortization schedule, they could break it up into 5, in which case you're taking it in chunks of 5-year term to have your interest rate determined. When you go into a variable rate mortgage, a variable rate mortgage could be a variable payment or variable fixed payment. In which case, the first one, variable payment, is your rate is variable. We're talking about your mortgage interest rate now when we talk about variable and fixed. Your rate is variable. That means it fluctuates with the market. You don't
Okay.
have.
When you say fluctuates with the market, what do you mean? Like,
So we have the Central Bank of Canada. Bank of
okay,
Canada sets interest rates. We have what we call the prime, and then the lenders could either be selling to you at prime, or some of them would offer discounts, right?
okay,
Today's rate, today's prime rate is 6.7% as we speak. Now, if you take that prime rate, right, some lenders would offer you a variable rate mortgage, and hey, they've given me capacity as a mortgage agent to discount 0.9%, 0.5%, 0.45, whatever the case may be. So if they give me the prime minus 0.9%, all of a sudden I could offer you a variable rate mortgage at 5.8%.
oh, okay,
When you sign up for a variable rate mortgage, they sign you up for a 5-year term, right? That's your minimum on a variable rate mortgage. But it doesn't mean you are locked into that rate for 5 years, because there's flexibility there. Now,
okay,
when we go into the variable payments, that means if bank of, like what happened between last year and up to early this year, we had a lot of interest rate hikes. Consistently, we had interest rate hikes for months, right?
correct.
Bank of Canada says, oh, okay, today's rate is 6.7. If they wake up tomorrow and for whatever reason, inflation or whatever the case may be, they, oh, hey, guys, we have to go up to 7%. We have to go up to 7.5%. If you're on a variable rate mortgage, your interest rate will change based on what Bank of Canada sets the prime rate to be. It would affect you as soon as any changes, right? Now, the variable puts you in a position where when you set up a mortgage with the bank
Mm-hmm.
on a variable rate, they have to calculate your monthly payments, whether you want to go monthly, whether you want to go bi-weekly. Your payment structure has to be in place. So
Okay,
if you have a variable, what that means is there's a portion of, I'm going to use monthly for easy math now. There's a portion of your monthly payment that goes to your principal amount, and there's a
okay,
portion that is allocated to your interest in that one payment you have. For instance, let's assume your monthly payment is $3,000 on the property you took on a mortgage, and in your first year, that's kind of what the amortization schedule does. There's a way they calculate what goes to interest, what goes to principal. The banks like to take
principal.
as much interest as they can in your first few years of owning a mortgage. So your interest rate in your first, second year is usually higher than when you get into year 3, year 4, year 5. That's how they
Okay,
spread out. So let's assume you started off with a 70-30 split. 70% of what you're paying is going to interest. The other 30% is going to your principal amount. When you're in a variable situation, they don't want you to lose the portion as it is being allocated. So if your payment is $3,000 and 70% of that, right, is going towards your interest, and interest rate goes up, all of a sudden, let's assume the amount you're paying towards interest was $2,000, for instance, and you're paying $1,000 to principal. When interest rate goes up, your $2,000 interest on that loan may become $2,200. In which case, you're not paying $1,000 to your principal anymore. If you're on a variable, the bank would adjust your payment. Make sure that you have covered that interest and you're still paying the percentage that should be going to your principal towards your principal. So every time the prime rate fluctuates, every time Bank of Canada increases or decreases rates, your payment would either increase accordingly or decrease along with a reduction in interest rate. That's on a variable level. But when you go on a variable fixed payment, right, you have a situation where a variable rate mortgage has been well calculated to say, okay, based on this, okay, you're able to pay your payment, monthly payment is $3,000. You have a fixed payment.
Okay.
If the interest rate fluctuates, right? Even if it means you're paying, if the interest rate goes up, for instance, if you're paying less to your principal, the bank, the lender keeps taking on the interest that they need to take. So in that 3,000 payment. If your principal reduces from $1,000 to 800, it's okay. The bank keeps reducing it. If interest rate goes up, they keep adjusting it. They're taking from your principal payment now to make up for the interest.
Hmm.
If it goes the other way around, where interest rate goes down, they'll take the interest they need to take, and then you pay more towards your principal. So your principal
Okay.
is reducing faster in a variable fixed arrangement, right? When interest rate is low. But there's something we call a trigger point that happens
Okay.
when there's interest rate hike. So there's so much that the bank can absorb, right? And
Yeah.
some mortgages got to the trigger point late last year and early this year based on these increases in Bank of Canada rate. So you get to a point where that fixed payment that the bank has promised you, your payment is not going to change. You're on a variable rate mortgage. That fixed payment the bank has promised you, your 3,000 payments, the bank has to write you when you hit the trigger point. The trigger point means you've gotten to a point where the entire amount you're paying is either all going to interest or
Right.
not even enough to cover your interest.
Hmm.
At that point in time, the bank is going to knock on your door. Sir, yes, we promised you that this payment is due, but right now it's out of our hands. You've hit a trigger point. We have to ask you to make up the difference. That's the time that the variable fixed payment can change. But when you're in a variable automatically is changing. So you're adjusting and changing with the pricing, whether up or down, you move with the market.
Down. So
Now,
variable, the movement is going on. Your monthly repayment is fluctuating based on
correct.
how interest rates are moving up or down. Okay, and the variable fixed or the fixed variable,
Yeah.
that means you're still paying the same amount, but the allocation of the interest and principal is changing in the background.
Correct. Until you hit
Okay.
a trigger point.
Got you. Got you.
So
And then the final one is the fixed.
now when you're going on a fixed rate mortgage,
Mhm.
you can go on 1 year, 2 year, 3 year, 4 year, 5 year, up to 5 years on an average. There's some very few lenders out there that would offer you a 6-year fixed, right? I've heard of a 7-year fixed before. I've never signed on any of those mortgages. They're very rare because most people don't do that. So it's also within 1 to 5 years on an average. Now, when you get to the longer you sign up for on the fixed rates, the better the rate you get. But in that instance, if your rate today is 4.5%, you go into that mortgage at 4.5% today and you go on a 5-year fix, they're guaranteeing that regardless of what Bank of Canada does, regardless of what happens, inflation, whatever happens in the market, your rate is guaranteed. So you stay on your principal allocation and your interest allocation and your payment, everything is fixed. You're paying $3,000. This is how your amortization schedule is going to be. You start at 80-20, it goes down to 75-25, it goes down to 70-30. It keeps the amortization schedule keeps proceeding. You are in a fixed situation, but only up until your term expires.
Okay.
When the term expires, the bank is going to renegotiate with you. You're still within the same term, you're still in your amortization schedule, but you finish the first leg, your first term is done. That's when your interest rate may change or stay the same, depending on what the market is at the time. So the banks don't want to guarantee a particular interest rate forever because they might end up losing money.
Yep.
And that's why they protect it. But if they are gaining money, well, they won't complain. But hey, that's kind of how it is.
It has to be fair.
Yeah, it has to. Yeah, cost of borrowing has to be reasonable. If not, then the market will crash. Something I was going to mention, amortization as well in relation to down payment. When you are in an insured mortgage or in any mortgage that you're financing less than 20%, sorry, you're putting in more than 20% down payment, most banks would not offer you more than 25% amortization.
Oh, right, I see.
When you cross that bridge to either an uninsured mortgage or an insurable mortgage, in which case you're putting in 20% or more as down payment, you start having options of a longer amortization schedule. That's when you start hearing people say, oh, I got 35 years amortization, 35, I got 30 years amortization. Those products are only available when you have a down payment of 20% or more. Your loan to value is 80% or less.
Got you. Got you. Okay. That was a very detailed explanation. Very very thorough, and I'm sure a lot of our audience would have benefited immensely from that. Um, there's one other piece that I was going to ask you about, which is around closing and the possible costs that are associated with closing.
Yeah.
So, I mean, when I say closing here, I mean like closing on a mortgage or closing on the purchase of a home.
Yeah.
So, what can you share with us around that?
So, well, first of all, for those that don't know, closing is when you actually put the deal together. When the day you finalize that purchase. Because when you buy a property today, doesn't mean that the deal is going to be finalized today. You and
Correct.
between the buyer and the seller, you set a particular date that is convenient for both parties to have things finalized. I put an offer on your property today, you accept my offer, and we decide, okay, we're going to close this in 30 days, we're going to close this in 60 days, we're going to close this in 3 weeks, we're going to close this in 120 days. So it depends.
So before you even sorry, Colin, sorry to interrupt you. So before you proceed, another thing I wanted to mention is so that maybe you can sort of like answer the question, collectively, is what shouldn't a potential homeowner or someone that's entered into an agreement to purchase a home, what shouldn't they do between when they agree to purchase a home and closing? What are the things they should avoid? Yeah.
Okay. So we'll put it all together. So the closing costs, first of all, that's one thing to also have at the back of your mind when you're going into a purchase. Your down payment is one thing, your closing cost is another. We usually say on a scale of an additional 2 to 3% budget to have towards your closing cost. And majority of your closing cost goes towards what we call your land transfer tax. Because hey, we're in an economy that is tax based. Government of Canada would not play with their tax. Everything, almost everything, and anything you're buying in this country is taxable, right? So when you purchase a property, the government is coming to you for tax. So that's you now paying to transfer ownership from whoever pre-owned that property to yourself. So you understand? So they're transferring the land to you. The property's title is going to you. So there's a fee that goes with that. That is what's going to carry the bulk of your closing costs. So you always have to factor that in. Your land transfer tax could be one or two portions of usually the same amount. It could be provincial only or federal and provincial. In some areas of Ontario, the government you're only obliged to pay provincial tax, provincial land transfer tax. In some scenarios, the closer you are, especially the closer you are to downtown Toronto, they charge you both. You pay to the federal and you pay to the province as well. So it's the same. If it's $10,000, it becomes 20. In which case, if you purchase just outside of that zone, you may be only paying just the $10,000. Now, land transfer tax also has there's a special rebate for first-time home buyers, in which case they get a discount because hey, the government looks at them as let's give them some soft landing. They're coming in for the first time. So if you do qualify as a first-time home buyer, you will get that rebate, right?
That's music. That's music to first-time home buyers' ears.
Right. So now that is
you get a discount. So
that's a major. The discount is a lot of money. You do get significant amount off of that. Your land transfer tax, as mentioned, like that carries the bulk. So when you do have an additional budget of 2 or 3% in addition to your down payment in reserve towards your closing costs. The other major thing that you're going to be paying for in closing is your legal costs. So
Okay.
the closing of a property, the closing of a purchase does not fall in the hands of the buyer and the seller, or even the real estate agent that purchased or sold the property. It falls in the hands of the legal experts, your lawyers. So you have to get a lawyer involved that's going to help in transacting. The seller must have a lawyer. The buyer must have a lawyer representing them as well. So the government puts the administrative part, the documentation, in the hands of the legal counsels from both sides. So you have to pay for that service. So the legal cost could vary depending on how much work that lawyer has to do on your behalf for closing. Okay?
Right.
So they do have their base amount. They'll charge you your HST taxes as well. And then there could be a lot of disbursements, costs that come in place depending on how that deal has to be structured, that the lawyer has to incur, that is then passed on to you as a client. So those are the two major things, right, that you have to cover on closing the property. Closing costs could also go as far or as deep as you haven't signed the lender had put out some conditions when they approved your mortgage, saying, hey, Mr. A, B, C, we approved you for X amount of blah, blah, blah that you applied for, but we see that you have $1,000 on your credit card. That has to be paid off before we can close on this, before we can fund this deal. So that may also factor into
closing
costs, right? So other than that, anything outside those specific things would be related to some special cases, which is usually not, well, it's not far-fetched, but usually your closing costs shouldn't go outside that scope.
Okay.
Now, in terms of closing, like Kaede said, there are certain things that, hey, when you apply for a mortgage and the lender looks at your profile, looks at your situation and says, hey, we're going to give you $500,000 towards the purchase of a house, $1 million, whatever the amount may be. They've looked at certain factors in your credit bureau, your income. So income debt, let's put it that way again, back to the income debt situation. So all those criteria and factors that made you qualify for that mortgage have to remain status quo until you close. So if you have a $50,000 credit card that was zero balance at the time you applied for a mortgage, on closing, that card has to be at zero balance. You can't say, oh, I did not have a car loan, like we mentioned before. I waited. I bought my house. I got approved for a mortgage. Next morning, I'm going into Mercedes Benz and I'm picking up a nice vehicle.
No, don't do that.
You still have to wait until you grab your key, until you've closed on that property. So no changes whatsoever to your financial situation until you have gotten the keys to that house. And even
so don't go and buy that Chanel bag, right?
Don't buy
that Chanel bag to celebrate the house purchase.
Wait to get the keys. Get the keys first. So you must remain status quo. It affects a lot of mortgages on closing.
Yeah.
People are not informed. They think, well, okay, I've been approved already, then I may as well. I'm waiting for that Chanel bag or whatever the case may be. I'm going for it.
Why are you looking at the team's direction? Why are you looking at the team's direction when you talked about the Chanel bag?
But hey, that's kind of
make him buy the Chanel bag. We have already closed.
That's pretty much what it is. Like it's you have to remain status quo because hey, the lender will have looked at your credit and then hey, talking about remaining status quo, you cannot afford to lose a job. In being approved and closing, because it's probably that job that got you approved.
can't even afford to change jobs
Even
if you
afford to
can
change
avoid it. Yeah.
exactly. So that's not the time to port. That's not the time to jump from one to another. You have
Yeah.
to remain status quo. Remain status quo in all ramifications. Anything that
Everything.
helps qualify you for that mortgage has to stay the way it is.
Until you get your keys.
Correct.
Yeah. Okay. Okay.
To stay the way it is.
Nice. Nice. So looks like we're we're just right at the top of the we're a little above the hour. Yeah, a little above the hour, and so maybe we can wrap things up and keep people waiting for the next episode of the podcast where we'll move forward on the series of renting to home ownership.
Yep.
On that next episode, hopefully we'll be talking to folks about the process of buying a home, and that's where Tino and I come in. We'll walk everyone through what the process entails, what to look out for, how tedious it can be sometimes, because it can be a little bit challenging sometimes, and the different types of services you should expect from a real estate agent. So we look forward to the next episode where we can share all of that with you guys.
Absolutely.
So I'll bid you a very warm goodbye from this end. I'll let Kola and Tinu, also say their goodbyes as well.
Yeah, so I mean, it was an interesting and informative session today. Again, just a few things to recap. Remembering to tidy up your credit situation. If you want to make this kind of purchase, you want to make sure that you're in a good credit spot. Your income matters, and you can always partner with someone if you want to purchase and you feel like you cannot go at it alone. If you have a partner, if you have friends, if you have people who are willing to do it with you, hey, come together. It's always a good way to start building income and wealth for yourself. You can never go wrong doing that. You're saving money, you're earning money, you're building your wealth portfolio at the same time. So partnering, looking for people who have like minds that want to achieve the same goals as you is important. And with that being said, I'm happy to do this again. Look forward to speaking with you guys next week again and chopping it up about purchase.
Okay, people, thank you very much. I hope we're able to get at least some knowledge out there, share some knowledge out there. And if you guys have any questions, please feel free to reach out. We're here to help. That's why we're here. So, any
Absolutely.
clarifications, more questions, be happy to help you. There's still a lot more in depth into a lot of these things we talked about. Tinker just brush through credit right now. That is a topic on its own. Having to let people understand and how to manage uh, credit that is sufficient enough to get you out there to be able to apply for a mortgage. There are certain tips that we would be sharing again some of the time as regards to how well prepped you should be in terms of your credit status before stepping out there to buy a home. So once again, thanks a lot to all our viewers. We appreciate you all. Thank you very much for the support and enjoy the rest of the week.
Thank you. Thank you. All
Thank
right,
you.
guys. Bye.
Bye.